Okay, welcome back. The pre-open, I think rates will start to come up in a minute or so. Chandan Tapari, a derivative and technical analyst at Motilal, is with us. You know, Chandan, when we saw these sharp declines in a very short period of time, what we've seen is that perhaps there's more to go, right? Because the market pretty much closed at the low point of the day on Friday. A little bit of bounce, but not very much. Would you go with that there is more left here before the market kind of bases out a little bit, or it's going to be more zigzag and confusing than that? What's your sense?
Good morning, Prashant and Sonia. We have seen that market has turned negative, and from last 7 to 8 trading session, it has been forming the lower lows. That means every day it is touching to the new lows, and resistance and supports both are gradually shifting higher. And the concern is that advanced decline ratio is negative. We have seen a spurt in India VIX by around 15% in the last week. The VIX has gone from 13 to 16 level. FI's long short ratio has gone to 47% from recent high of 75%. So structure has definitely turned lower, led by negation in high rise, high lows of the bank Nifty, and led by breakdown in the Nifty below its 50-day exponential moving average. So I believe that short-term trend has turned negative, and because of that, some bounce will be there, but that bounce could be sold because already we have corrected by 1,000 points. So undertone is negative, but use the bounce as a selling opportunity. As of now, the structure and the sentiment and the pattern indicates we have more downside to left. However, we tested a key level of 17,777, and this is the level which we made high in the last Bazaar. So technically, any bounce towards 18,000, 18,081 is sell on bounce strategy, and again index can go down to our 17,500 marks. Now talking about Bank Nifty index, which has negated higher lows of last 10 weeks and turned lower. So now the hurdle is near to 42,500, and we believe that selling pressure could continue more into the banking index as well. Now talking about stocks, see here already market is corrected. So we need to keep two things in mind. First, try to find out the stocks which are having the relative outperformance and resilience so that we can accumulate those stocks for next bottom out process to drive the next move. Second, we have to play the immediate downside move of the market, especially in intraday trading point of view. So I mix two set of trade here. So first trade is buy on M&M. This stock earlier done well. Overall year on date basis, the stock has delivered good gain, but in last couple of days, we were witnessing some selling pressure. But we have noticed that in last few days when market is falling down, this stock is finding some stability and taking support at lower zone. So because of that, recommending some bounce back to play in M&M with support of 12.5 for upside move towards 12.90. Now sell idea, that is on Tata Steel. Most of the metal stocks are looking weak. Tata Steel has given a breakdown. It has gone below its rising trend line with hold of open interest on the short side. Call writing is also seen in the counter. So recommended to sell on Tata Steel with a stop loss of 105, and the stock can correct by 5 to 7% toward 95. So overall negative bias and Nifty sell on bounce could continue. Buy on M&M and sell on Tata Steel, and most of the metal counter could continue in this market.
Okay, thanks a lot for that, Chandan, and have a great day. But let's see, the important thing is whether the Nifty holds on to the 200-day moving average or not. Anuj is here for a quick trade setup. Anuj, the last trading week of the year. What a year it's been, but do you think there are more downsides coming? Does it look like that?
First of all, good morning. What did you do to the market in my absence? As I left Nifty at 18,420. And I'm back and I'm seeing it at 17, whatever it is, 680. But look, the market...
Maybe the market missed you, Anuj.
I would take that. Okay, look, I'll tell you what, the market fell under its own weight. We discussed this probability that the market was so overbought that if a trigger comes, the market might fall a lot. I think COVID was an excuse, not perhaps the reason for the market to fall. The market, of course, always finds excuses. But the thing is, the market was overbought. Now it's oversold. And my sense is that while this may be a correction which ultimately takes you to the 200-day moving average, and the texture is sell on rally. Before that, you might see one rally, and I think that could happen as early as maybe today itself. If intraday you see a reversal, it's too late to take any short positions on the Nifty. That's my sense. Though the first rally today would be sold into or could be sold into, because we are at a very major support. If you draw the trend line as well, we are at a major support. So my sense is at some point today, you might see a rally today. Levels perhaps are not as meaningful. Price action is. So what I'm trying to suggest here is you have a gap up that gets sold into, and then the market breaks Friday's low. Everyone gets on the short side, and then the market gives you a long trade with a 50-60 point stop. Maybe that's something which can work. And keep an eye on the market breadth, because on Friday, the Nifty is not even reflecting the kind of pain that people have right now. In 3 days flat, a lot of people have seen 6 months or 8 months of gain wiped out. So I think that's something that you need to monitor what's happening in the broader market.
All right. Thanks very much, Anuj, for that. So, absolutely, maybe a bit oversold in the near term. So once we get through that and correct that oversold, what next is the question. That perhaps maybe, selling the bounces, etc. Now, just two names that we put out on our market laser segment. So I'm looking at Container Corporation and I'm looking at Tata Motors today. Container Corporation, these are just two simple chart setups which we are kind of highlighting. This is Container Corporation. This is a daily chart, spot rates. And as you can see, it's a simple trend, rising trend line all the way from the 20th of May. I mean, Concord did not make a low in June. It made a low in May. And it's sitting exactly on that May 20th rising trend line as of Friday. And actually, as of Friday, it broke that trend line and it's below that. So, these setups, sometimes I presented a similar kind of setup on PVR and Indian hotels on Friday. PVR ended 7% lower. I'm not suggesting something similar here, but I mean, Container Corporation is something to keep on your radar. It's just about on Friday for the first time after many months coming under that trend line. The next is Tata Motors, which I just want to quickly highlight. The stock will come up on your screen. Now, this is again a level to be watched. This is, price pattern. Again, daily charts for Tata Motors going back all the way to, this is, October of 2021. So this is, more than a year-old chart. The first touch point is October of 21. And then, the low in March of 2022. There's a touch point in May of 2022. There's another one in June of 22, which is the low in June. And then now finally we are, after all said and done, back at this at about 378, which was Friday's close. So again, this is as good a level as any if Tata Motors has to bounce from here or kind of accelerate on the way down. But this then becomes a bit of a pivotal zone to watch out for. So just two charts on the radar that I want to highlight: Container Corporation and Tata Motors.
All right, Container Corporation and Tata Motors sitting at important levels. So these are the stocks that we will monitor. But, as we look back at 2022 and look forward in 2023, one of the themes that really stood out in the previous year was the power sector. Because if you just take a look at a couple of these names, among the top 5 Nifty performers, we had NTPC as well, up 31% in 2022. We had Power Grid, which was up around 3.5%, but big moves in a couple of these other names as well. NHPC up around 24%. We had a big move in Adani Power and Adani Transmission. Adani Group stocks, of course, were on their own orbital moves in 2022 itself. So the list of these power players comes up for you. Let's discuss how the power sector itself will perform in the next year. Harshvardhan Dole, who's the Vice President Institutional Equities at IIFL, joining in now. Harshvardhan, thank you for joining in. The first half was good in the sense that we managed to navigate through coal availability and a lot of the other challenges. What is it that you're looking at in the second half of financial year 23, more importantly calendar year 23 as well?
Hi, good morning. In the first half, the power demand was actually very strong. It grew at almost 11 to 12%. On a higher base, of course, the power demand will slow down in the second half. And we're forecasting on a full year basis, the growth to average anywhere between 6 and 7%. Now, relative to the working capital which is available within the system and all the constraints which are well known, I think we are well geared to meet this particular power demand. That, in my opinion, is a great thing. The system seems to be, well geared to meet up, the demand patterns which are lined up over the next maybe 6 to 8 months. And we'll have to take a call on quite a few other things as the second half of the calendar year maybe pans out. So I'm not as pessimist as I was, say, 12 to 18 months ago, as I am right now when I'm looking at next maybe second half or so.
Okay. Always good to be an optimist, right? Let's talk about individual stocks then, Harsh. The power performer of the year, power packed performance of the year has come in from NTPC. It's a 31% rally that we've seen. What are the triggers that could further exacerbate that gain for it? And what do you see as, what's your target price on NTPC now?
So NTPC actually is our top pick. And the reason is very simple. On a consistent basis, NTPC will add about 6 to 7,000 megawatt of capacity each year for the next maybe 5 to 6 years. The capacity addition could actually could be much higher if the government addresses the key issues which are plaguing the renewable sector. And if the financial health of the states kind of improve, the coal-based capacity additions could actually also fast track. So we are forecasting close to about 10 to 12% base case earnings growth for NTPC for the next few years. And then relative to the cash flows, the dividend yield, the stock is kind of very cheap, close to one-time book and a dividend yield of 6% plus. I think the payoffs are asymmetrical. We continue to like that name. And the key trigger to look out is basically the value unlocking, which is lined up from the renewable subsidiary. If a strategic investor is inducted in that entity, I think there's significant gains for the minority shareholders. So we continue to be upbeat and bullish on NTPC, regardless of the massive outperformance last year.
So this value unlocking you're talking about is that 20% stake that they're planning to sell in the green energy business, right? That's valued at almost 3,000 crores, I think. Is that it, or is there anything else that you're looking at as well?
See, I think you're right. The 20%, up to 20% stake is what the company might end up selling. We'll have to see what exactly the valuation pans out to be, but that will be one of the key triggers.
No, just hang in there. We'll quickly take the 9-10 technical trades and come back to you. Sudarshan, what's your 9-10 call? We also have Mitesh with us, but first, Sudarshan.
Well, for intraday trading, consider buying the Nifty using intraday tools. Alchem Labs is a buy with a stop under 3,000.
And Mitesh, what about you?
I will go with a long call on Britannia. It's come down to support levels. So keep a stop below 4,300. Look for a first target of 4,400.
All right.
We'll go back to Harshvardhan. Harshvardhan, you said that there would be some unlocking in NTPC's renewable arm, etc. That could be one of the triggers. But 2022 was also important in the sense that we did see the return of the non-renewable, so to say, earlier ESG affected stocks. So do you think that's a theme that will play out in the next year as well? Are you looking at any of the renewable names as your top picks, or maybe you are sticking with the older traditional power players?
See, I think what excites us is the cash flow and sustainability of cash flow and return ratios. So whether it comes from renewable or traditional really doesn't matter. But if I were to look at the spectrum of companies which are getting into renewables, there is a stress on cash flows, there is a stress on return ratios, and therefore we are slightly cautious on the overall renewable space, and we'll try and revisit the whole space once these systemic issues are addressed. But for example, the opportunity landscape is significant, but the capital costs have gone through the roof, and a lot of these companies are trying to commit themselves to a fixed tariff for a protracted period in time.
Got it.
I'm really not sure how this overall math will look at, and rather to be cautious than to be aggressive on the whole space.
Harshvardhan, it's a pleasure. Thank you very much for your time. Great speaking with you. There's 3 minutes to go for the market opening. So let's just take a look at the pre-open rates where they've settled, because we will get let's have the Nifty pre-open rate up. It's indicative of a 25-point higher start. So, the way this could, the SGX was indicative of a 80-90 point gap up. If it was a 80-90 point gap up, I mean, in all likelihood, that got sold into almost immediately. A 20-point gap up, I mean, unless, of course, there is a fair bit of pressure straight out of the gates. I mean, maybe, this holds, perhaps, we see a bit of a bounce, and then at some point that gets sold into. It's not going to be a straight line, absolutely not. But the fact is, 2 days now, the market lost, Thursday and Friday, lost almost 4% on the Nifty. So that is pretty substantial that we have had. So 17,830. I don't know if you can have stocks up. Mitesh, any thoughts? I mean, the gap up is much smaller, 20 points.
I think, see, the initial gap up wouldn't have mattered much, Prashant, to me, because, the idea is that, one, we don't have positions. Two, I think a significant gap up would invite fresh shorting. I think around 18,000, 18,050 is what I'm looking at. Otherwise, just wait it out. and maybe a break below, yesterday's or Friday's low could trigger some continuation.
So just wait it out. Just also keep on your radar some of these auto stocks. There's been a deep sell-off in the last many days, especially names like Tata Motors, which is the top loser on the Nifty this month. It's down 15% this month already. Eicher Motors down about 10%, Maruti down 10%. So in the brutal move that we saw on Friday, a lot of these stocks have been under pressure as well. We have less than a minute to go before the market opens. It's not going to be a big recovery compared to the sell-off. It's a pretty lackluster recovery that you could expect today. And will this be used as an opportunity to sell into? That's the question, because the trend is definitely on the downside. So let's wait by for the first take on the index. The opening bell just going to ring now in seconds. The first opening is absolutely quiet. In fact, the Sensex is already in the red, and now the Nifty mid-caps are sort of, just flatlining. What's gaining this morning is a lot of the pharma names. So there is a defensive move definitely. Sun Pharma, Divis, Cipla, all in the green right now. And you have something like Dr. Reddy's as well that's holding up. Apart from that, auto stocks this morning are not doing badly. Bajaj Auto, Eicher Motors, Hero MotoCorp holding in the green, but barely really, just few and far between. On the downside, you have Asian Paints, Ultratech Cement, BPCL, Tata Consumer Products and L&T that are a tad bit in the red. Now the Nifty is picking up a bit of pace, so in line with what the SGX was suggesting, perhaps 35 points. But it's really, it's not a conclusive recovery that you're seeing after the sell-off that we saw. So it's better to be a bit cautious in the market. There are a lot of stocks from the heavyweights that are exerting pressure, whether it's SBI, L&T, Kotak Mahindra Bank, HDFC Life, Bajaj Finance, HUL, all trending in the red now. And the market is so very quiet. The breadth, though, is slightly in favor of the advances. So, and by the way, the Bank Nifty has now moved into the red, and so has the mid-cap. So as expected, the minor up move that we've seen has been used as an opportunity to sell into, and now all four indices are trending in the red. So there's still quite a bit of caution. What else are you noticing in the broader market?
There is a fair amount of caution, and the breadth that you spoke about, 1,500 stocks advancing for about 900 stocks declining. Let's see how that pans out through the course of the day, because on Friday this was extremely weak. In terms of the markets now, conclusively in the red for the mid-cap index, which is down almost 0.5%. But despite that, we're seeing some stocks do well. Suven Pharma, understandably, because the deal has opened about 5% higher and is gaining, though it'll be interesting to see how much do we have in terms of incremental gains out there, because a large part of that was factored in by the street itself. We're seeing some weakness on Quest Corp this morning, this on account of the fact that they've withdrawn their amalgamation idea with Alsec Technologies, a move that would have caused some synergies, but now that has been withdrawn, so that stock is under pressure, was down 4% on Friday's trading session as well. We also are seeing some moves on restaurant brands Asia. They're bringing Popeyes to Indonesia, so that should be a positive. The stock's opened about 1% higher and now has quickly sold off. In the broader markets, we're seeing some bounce back in a couple of these PSU banks. So Union Bank is up around 2%. All of last week, it saw a brutal sell-off. So, that is something we'll monitor. And some up move is what we're seeing in Siemens and a couple of these other names as well. Same, something like, Jubilant Foodworks, mildly higher. We're seeing some moves on the way up for Alembic Pharma as well as a result of the deal that the company has announced. Alchem is the other one which is in focus. So we'll watch out for a bunch of these stocks. Nothing really to write home about. The mid-cap index in the red, while the Nifty is just shuffling between red and green around that 17,800 mark.
Mangalam, quiet, right? Quiet is how we would like the markets this week, and spend some time doing not very much, no big pullback, and nothing, of course, like what we saw the last two sessions of Thursday and Friday last week, and that would be, absolutely just a holding pattern. Wrap this year out and then come back next one. I think that would be ideal. But of course, the market usually does things in more unexpected ways. So we'll see. UCO is down, I think, as you said, down 5%. UCO went up 3 times in basically, 2 months, right? So that's been a big pullback actually amongst the PSU bank space. Bajaj Hindustan is down about 4.6%. Sugar, by the way, has been did well, is coming under pressure. Timken India is down 4%. Just trying to spot things with volumes, but they are hard to come by. It's kind of low volume session, at least with the word go. And if things pick up. Maruti Laboratories has been jumping last few days. It's up another 9%. It's the top traded name across on the NSE. So that is Moripun on your screen. Union Bank is up about 3.5%. Suven, I think we mentioned 2%, 506. IOL Chemicals and Pharma, that's 3% higher. Decent sized volumes for this time of the day at the word go. GIC RE is about 3% higher. And you've got Nureka, which is about 5% or so. Nureka, by the way, has been doing very well last few sessions. I think it was a good week last one, even in the market turmoil. And it's starting higher this morning as well. SJVN, there was news flow, Vivek highlighting that 4% higher on SJVN. I could go on. I mean, Ease My Trip is up 4%, Karnataka Bank is up 3.5%, and so on and so forth. Market, by the way, is turned around. I mean, it was declines outnumbering advances when we started, and by about 200, 250 stocks, but 1,100 stocks on my screen are higher. And the declines is about 780 odd stocks, and the gap is increasing as we go on. I mean, actually, it was a good open, right? I mean, because if it was an 80, 100 point gap up, short sellers would have come, sold the market, and you would have seen markets getting flat. But we started 20 points higher, went up 40, 50 points, gave back some, and now kind of finding some kind of a, not equilibrium, but 25 odd points, 17,828.
A pretty feeble recovery in the sense that not only has the market not at all recovered from what we saw on Friday, but this week most people are on leave, right? So the volumes will also be on the lower side. I guess the real trend is what you'll get to see from January once people come back.
Maybe not in the first week of January. Maybe usually 7th, 10th onwards is when full activity, full volumes, etc. come back, especially from a foreign investor point of view. But in any case, I mean, given what we have, this is not a bad start, with about a 40, 45 odd point again at the word go. 17,857. Mind you, because there was such a sort of waterfall kind of decline on Friday, there would have been margin calls, etc., which would be called into, and that would be today. So I think post 10:30 or so, I think you should get a real sense of, after all of that is done, accounted for, I think you should get a sense of the market on a more cleaner kind of a note with last week's sell-off behind. Now, Andrew Holland is with us. He's our Market Master of the Day, Chief Executive Officer at Avendus Capital Public Markets, Alternate Strategies. Andrew, great to have you with us here. Thank you very much. It's the end of the year, so volumes, of course, will be thin. But given as they are, what is your sense, Andrew? What did you make of the selling last 2 days? To your mind, was there one dominating driver? And what next, near term?
I'm not sure there was one dominating driver, Prashant, apart from obviously, there's still there's some great gains to be taken off the table, in some of the sectors, say PSU banks, it performed so well. It's always there for taking some money off the table. So I'm not overly kind of concerned that the market had this sell-off. It's kind of in line with what's been happening globally, so it's not out of context with anything that's out there. Maybe the severity was a little bit more than people expected, but here we are again looking into 2023, and we are kind of the same dilemma as we came into this year. Is the market right? Is the Fed right? If you remember last year, coming into 2022, market was fighting the Fed about whether inflation was transitory, and going into 2023, we're fighting the Fed of whether interest rates need to be kind of hiked up a lot more, and when will actually they go on pause. So that's going to keep the market, I think, in January, still occupied and volatile. In terms of, we've seen over the past month, right, we've gone from kind of the Goldilocks scenario to a recession again, and the figures are still not supportive of the Fed, reducing so quickly. So I think that's what's going to, keep the markets the volatility of the markets kind of quite high, at least in January. And of course, for India, we have our budget coming up in February. So again, there might be some, kind of volatility around that in terms of what the finance minister may or may not do.
I guess, Andrew, hi, morning, and happy New Year to you and your team in advance. I guess these are the best times to be accumulating, right? When the markets are volatile or when the markets are under pressure. What would you do with some of the key pockets like IT? What side of the fence are you on? Because we do have IT earnings coming up in a fortnight as well.
See, I think the sentiment towards IT will be obviously continue to be driven by what's happening in tech in the US, and the correlations remain very high, and it's been throughout most of this year. So unless you have a very positive view on tech, and I think that can only be that you expect interest rates to fall sometime in 2023 globally for that sector to start seeing some relief, because it's all focused on cash flows. And for a lot of these tech companies, they've been found out to the fact that valuations are high, but profitability and cash flow wasn't there. So I think that will continue to be a theme that kind of haunts the sector in the very short term. So whilst I'm not saying that our IT companies are doing very badly, but I just think the sentiment remains against them in the very short term. I don't think valuations are quite there yet that it's compelling to be buying them. I think there's other themes that will play out throughout 2023, which will be much more exciting.
Andrew, I think your lack of concern over the markets declining is something that the street has caught on to right now, because now we're gaining a fair amount of ground from the morning lows. In fact, the Nifty is up almost 100 points from the lows we hit this morning, closing in on that 17,900 mark as well. And the mid-cap index, which had a rather volatile first 15 minutes of trade, or rather first few minutes of trade, has now picked up further steam. The advance decline firmly in the ratio of advances. 3 stocks advancing for just 1 declining. Advance decline, 2,100 stocks in the green for just around 650 in the red. There you have it. The lines, now far apart, with the green one much above the red one right now. As we speak, bunch of stocks doing well. HDFC Bank at the high point of trade. Britannia, which was Mitesh's 9-10 call, has moved to the high point of trade as well. HDFC Limited too has done extremely well, and the PSU pack is picking up. We have Union Bank, which is up almost 6.5%. PNB is up around 3% as well, and a bunch of the other stocks doing well. Andrew, the last time you joined us, we were sitting at a fair amount of weakness for all these platform stocks, Nykaa, Zomato, Paytm, etc. You said that after the sell-off that you saw in them, maybe valuations were interesting and you liked those ideas then. Since then, not much has moved in terms of prices. Are you any wiser now, and would you, look at accumulating any of them now that they've corrected and the flows fear is out of the system?
I think there's still a little bit more time before putting money to work there. I think there's still concerns over cash flows and the margins of each of those businesses. So I think another quarter of these companies starting to deliver, I think would be something that the market would like to see, and ourselves as well. So the work continues. It's not going to be a quick kind of analysis. It's going to be an analysis which takes time, because a lot of these companies, in terms of getting to profitability, is still in question, and I think that's what you've got to be assured about, that's a working kind of a work in progress for the managements of these companies. So I'm not saying that it's not the right time to kind of bottom fish at the moment, but I just think you need to have a little bit more kind of results behind you which are showing this progression. Even if you miss the first few percent of a rise, but you're getting it right for the long term, that's where I think I'd be looking for our investments at the moment. So no need to rush. There's plenty of time. These companies are not going away from us.
Okay. 2 spaces that the market has been increasingly bullish on. One is capital goods and the other one is defense. Of course, defense has played out in a big way this year as well. But your thoughts on whether these could continue to be outperformers in the year to come?
Yeah, I mean, it's been one of our long-standing themes, throughout this year, in that there's a global theme that's playing out. One is renewables and one is defence, and that's going to continue into 2023. So that's a space which you just need to kind of continue to invest in. I think in terms of capital goods, and again we spoke about this, in terms of, yes, you'll get the usual roads, bridges, and highways being built, but I think because of the capital expenditure CapEx cycle, which we expect globally, it's going to be more towards those industries where there's a security supply problem in the past or potentially in the future, and therefore it's going to be the different CapEx cycle than we've seen before. So it's going to suit the kind of the Siemens, the ABBs, and so on. It's not going to be traditional L&Ts, BHELs, which I think will be leading the CapEx cycle this time around. So I would look more kind of directly towards those which are going to benefit from new industries and manufacturing facilities being built, but not in the traditional way of previously.
Towards the end of the year, we typically see a lot of these holiday/travel/enjoyment stocks do extremely well. Although last week they were under pressure on account of fears of what's taking place in China. Now they seem to have bounced back a tad. We have Ease My Trip, which is up 7% odd. Indian Hotels is bouncing back from the lows as well. A lot of these hotel stocks are doing well. Delta Corp, which was an underperformer last week, has now moved to the high point of this morning. Andrew, you have any preferences here in any of these unlock/enjoying/travel and leisure themes?
Yeah, Mangala, I'm not sure about the enjoyment of the prices we're paying for some of these trips, but I do feel that, again, if travel restrictions, I'm not saying that they're kind of coming back anywhere, but if people are just worried about traveling again in the very short term, then it only lends itself, to stay in India and travel in India. So I think this is a theme that's not going away, and the capacity utilization in these hotels is fantastic, and you go anywhere, it's difficult to get tables. So I don't see this. I see that the fact that COVID for 2 years stopped us doing a lot of things. I think we'll continue to want to enjoy what we've been doing and have more experiences in our travel, and I think that's going to be the big theme. And if the hotel industry can capture some of this, and the travel companies themselves, then I think we'll continue to see very, very strong growth in the industry.
Like someone was saying, right, 90% of travel these days is just waiting for your table, waiting for your reservation, waiting for your flight to take off. So there's not too much fun in that. But nevertheless, have a great 2023. And until we speak and meet again, Andrew, thanks a lot for speaking to CNBC TV 18.
Thank you, and wish you and the team and your viewers a very happy and prosperous 2023.
Thank you so much. Thanks for joining in.
Look at the market, right? Full 100 points now. So 17,900 plus is what we have on the index. So this is looking, so we got a 300-point fall, right, on Friday, and this is a 100-point bounce that we have. But I would suspect that this is the first act in what will be many acts through the course of the day, right? I mean, this is the first serious bounce, but let's see if this holds or this gets sold into. I would suspect at some point it gets sold into, and then maybe, perhaps a little more durable kind of bounce starts to set in. But 17,892, it was a damaging fall on Thursday and Friday, and we're coming out this week in at least some stability. I mean, it's not a big bounce or anything, but just stable markets and not a continuation of the big momentum that we had on the downside. Sonia.
Okay, well, whether the markets fall or not, one thing is for sure that people are going out there and buying, right? They're buying homes, they're buying cars. There's that K-shaped recovery that everyone's talking about where the luxury homes and cars are being bought. But the lower end of the spectrum is still dealing with the, loss of jobs, perhaps lower employment, as well as, rural income has not come back in a big way. But to get a sense of which way things are headed, Keki Mistry, Vice Chairman and Chief Executive Officer at HDFC, joins us now. To just give you a sense, HDFC had a fabulous quarter gone by, of course, reflective of what happened in the sector itself. It was the best asset quality that HDFC had reported in the last 11 quarters, and loan growth was very strong. Mr. Mistry, good morning to you, and always a pleasure speaking to you. Merry Christmas and greetings of the season. How do you feel about the year to come? I mean, we've spoken ad nauseum about how things are going to shape up, but it was a very good year for the real estate sector. What are the big triggers lined up for the new year?
So first of all, let me wish you, your viewers, a very Merry Christmas and a very Happy New Year.
Thank you.
I think the year ahead, the last year has been a very good year for the financial sector per se, and but also for the housing market. There are several reasons which have contributed to that. One is COVID made it more imperative for people to look for bigger and larger homes. Secondly, in the period from 2016 to 2020, property prices did not increase at all. And therefore, we were in a situation in 21 and 22 when home prices were more or less the same as they were in 2016 with much higher income levels, which led to a significant pickup in growth. And once the momentum started, the momentum has continued unabated till the time we speak today. Now, the structural demand for housing in India will always remain strong. I mean, it's not a 1 year, 3 year, 5 year, 10-year view. It's a very, very long-term view for various reasons. One is very underpenetrated market. Mortgages in India are just about 11% of GDP, which is amongst the lowest in the world. Affordability has improved a lot over time because prices have not moved up in line with the way incomes have moved up. So all in all, the outlook for the sector remains bright. The government also has been very focused on the sector by providing fiscal incentives and a variety of other things, the credit link subsidy scheme and so on and so forth, all of which has benefited the sector. So I would expect the growth momentum to remain strong in the years ahead.
Mr. Mistry, one thing which gets talked about when we talk about the real estate sector is that it usually when you turn a corner and start a cycle, up cycle or down cycle, it lasts for a number of years. We are perhaps already into year and a half, 2 years of this one. Do you have more visibility now of how long this momentum may last, or just some qualitative aspects around your thinking?
I think as long as the feel-good factor remains strong in the economy, I think the demand will continue to remain strong. The primary factor is that the family must like the house, the job should be secure. All of that has contributed to the growth. Now, if you look at attrition rates in many of the companies which employ a large number of people, attrition rates have gone up over time, which means that there are job opportunities. And when there are job opportunities, when your salaries are increasing, you have that confidence to, take the plunge and look at buying a house. So as long as the confidence remains high in the economy, I think the growth will remain strong. And I honestly believe India is so well positioned at this point of time that the growth momentum for industry as a whole can continue unabated for very long.
Now, Mr. Mistry, you recently also started funding self-employed category for housing. You talk about salaries, attrition, etc. But we've seen a rising trend of people starting out on their own, being part of the gig economy, etc. as well. But if you look at HDFC Limited's history, you can be called a relatively late starter in that category, perhaps on account of your own risk-reward sort of framework that you had. In that case, in this self-employed category itself, do you think there could be competition with incumbent dominant players already? I mean, what's your strategy there?
All right. So first of all, let me tell you that we've always been lending to self-employed people. It's not that we started lending now. We've been lending to self-employed people now for decades, for two decades or more. But roughly, I'm giving you very, very approximate numbers, roughly about 80% of our loans are to the employed category and roughly about 20% are to the self-employed category. Competition is there in the market. Competition is there for any kind of business. But because the growth opportunity in the market is so very, very huge, nobody needs to do anything which is irrational. No one needs to do anything which would, hurt the sector because the growth is there for everyone to have. So whether it is employed category, self-employed category, of course there is competition. But notwithstanding the competition, we have, if you take the last 10 to 12 quarters, you will see that we have consistently grown at a pace which is faster than what the system has grown. So we continue to get market share.
So if you're talking about loan growth, right, or AUM growth, is it something that you can sustain? I mean, the growth has remained very healthy on an average of around 12 to 16% if you look at the last 6 quarters. And in the quarter gone by, it was about 15.5%. Is this a level that HDFC can sustain even in the early part of the new calendar year?
Sonia, when you talk of growth, you should not look at the balance sheet growth. You should look at the growth in the individual loan segment. If you look at the individual loan segment, our growth has typically been between 15 and 18 or 15 to 19%. Last quarter was higher at between 19 and 20%. So look at the individual book, don't look at the non-individual book. Why you should not look at the non-individual book is because this tends to be very volatile. If you look at the breakdown of our lending today, roughly 81% of our loans are to individuals, roughly 9% are for construction finance, and the rest is corporate loans and lease rental discounting loans. Now, the construction finance book did see a slowdown in terms of new projects getting launched between 2017 and 2020. Now, typically a construction finance loan takes time to disperse. So it's not like a corporate loan where you disperse the entire amount up front. In a construction finance loan, the disbursement is linked to the stage of construction. So as the developer keeps building, as he keeps constructing, we keep dispersing. So disbursements tend to be back-ended. So because between 2016 and 2020, not many projects were launched, we did not do too much of incremental approvals in that period. Those are the kind of loans which would get dispersed today. The pickup has come from 21-22, but that pickup will only get reflected in the loan book over a period of time, because first the developer has to put in his equity, then he starts constructing, and then we disburse money. So look at individual loans. So if you look at individual loans, a 15 to 20% growth is what we've seen for a very, very long time, and I feel extremely confident that that growth momentum can continue unabated for a very, very long time.
All right, so that question answered. Then let's talk about the interest rate scenario right now. I mean, if you just take a look at your net interest margin and spreads in the previous quarter were lower by almost 4 to 5 basis points. Net interest margins too, from 6 quarters away level of close to 3.7 have come to around 3.4. Do you think they've stabilized here, or there's some way more for them to narrow going forward?
If you were to look back at what we told investors 6 quarters ago, we said that the 3.7 is a bit of an aberration. And even at that time, when we were giving our results, we said that our normal guidance is between 3.3 to 3.5. So we feel confident that spreads would remain in that band of 3.3 to 3.5%. I'm not talking of spreads, I'm talking of net interest margin. So net interest margin should remain between 3.3 and 3.5. And spreads, I think the 2.25, 2.27, 2.28, I mean, let's not get into 1 or 2 basis points here and there. 2.5 to 2.8 is typically the level of spreads we've had for a long time.
So there is no hit on demand that you are expecting because of the rising interest rate situation, right? I'm asking because most developers tell us that generally there's no correlation up to a certain point. But now interest rates have been rising for a while. So do you see any impact on demand at all, either affordable or premium?
See, Sonia, what happens is when interest rates go up, sentiments do get impacted. Economically, it does not really make too much of a difference, because no one gives fixed rate loans today. Everyone gives floating rate loans. When you're giving a floating rate loan or when you're taking a floating rate loan, it really doesn't make too much difference where interest rates are at the point of time when you take a loan, because interest rates move in cycles. So you will have cycles of rising rates and you will have cycles of falling rates. And in a 15-year term, typically, which is a housing loan term, you will have 3-4 such cycles. So it really doesn't make much difference whether rates are low or high. But yes, sentimentally, it does have an impact. Typically, what we've seen over time is that when rates are increased for the first couple of weeks, there is a bit of a slowdown in terms of new applications coming in. But by the time a couple of weeks are over, people just get adjusted to the new interest rate environment, and the momentum comes back to what it used to be.
Just a bookkeeping question. The merger date or the merger timeline for both HDFC and HDFC Bank stays on course, right? I mean, when are we looking at the record date, etc.?
Typically, we had said that around June is when we would expect everything to be completed, and that remains on track.
All right, Mr. Mistry, thank you very much. Great speaking with you. Appreciate you joining in. And season's greetings from all of us here at CNBC TV. Thank you. Thanks very much.
And one Merry Christmas to all your viewers.
Thank you, Mr. Mistry. Well, the market's up 140 points, so this is good news that we are reporting. A bit of a bounce, some stability is what you have. Just a few names I want to pull up, because this is new stuff into the mix. Market breadth is looking good, and I think that is what one needs to watch. 6-1 in favor of advances after a negative start on market breadth. Look at Yes Bank, if you can have that up. Just a few intradays. IOB, Union Bank, both 6% higher. So Yes Bank, IOB, Union, all three banks right at the word go. Big volumes on all three. Zomato is up 10%, 11% actually on Zomato. That's at what, almost 60 rupees. There is IRFC, which is up at about 30 odd rupees. It's a 9% gain on that one. Kalyan Jewelers is up 6%. South Indian Bank is up 8%. Ease My Trip we mentioned earlier with a 7% gain. SJV and Satluj Jal Nigam, that's 7% higher. And you go down and then volumes start to thin out, but this is not bad. C8 is up 6% as well. C8 at about 1645. That's a large name, which is sort of looking up at this point in time. So 135 on the Nifty, broader market, some semblance of stability. That's a good way to start the new week. We'll take a break here and we focus on the mid-cap part of the market with two fund managers. Gautam